we are almost halfway through 2023 and things are still crazy. So today we're going to go over what is happening, what's going on in real estate, and we're going to give my 2 cents with each topic we're about to cover. So now going into the real estate market, this coming from Charlie Munger, who is, he's one of the GOATs when it comes to investing. He's Warren Buffett's right-hand man. Says the U.S. commercial property market is in trouble. And Elon talked about this too. There's a lot of people talking about how there's a big problem coming in commercial real estate. One of the obvious ones I think for us to see is office and how the use of office has changed, primarily due to 2020. Companies don't have everyone coming into the office anymore. And so for a company, at least some of them, they found that by not having a huge footprint, that's a huge expense that they're able to save by allowing people to work remote. Well, in commercial real estate, primarily the value of the properties are based on the income that's coming in, right? The net operating income is really how you get to a valuation. If these buildings are vacant, I think the vacancy rate is getting close to 20%, which is that's financial crisis numbers. You can imagine what that does to the value of the property. So I'm expecting office is just going to get walloped. I think that's the obvious one. Another one to be mindful of, and this is actually what I think is going to be the opportunity, and I'll try to explain it in a simple way. When you build real estate, you're primarily taking out short-term debt. This is either like bridge debt or a construction loan. Maybe it's a 3-year loan. And you're doing that so that you can build it, you can stabilize it, which means you have tenants coming in that pay your expenses and your debt, and then you move over into your long-term kind of fixed debt, the good stuff. Well, if you were a builder prior to the Fed jamming rates up, you were most likely expecting your project to be in a totally different environment than we're in right now. The environment we're in right now, as you can imagine, interest rates are much higher, and the debt market is pulled back. It's not as easy to qualify for loans. And so a lot of those projects, as they get to the point of stabilization, I don't think a lot of them are going to qualify for what they were expecting to get financing for. I guess an easy way to say it is when they started the project, if they were expecting a bank to give them $50 million on the project, now they're only giving them 40. And they have to make up that difference. They're going to have to go out and find that money. Now, a lot of people are saying because there's going to be a liquidity need that all these operators or developers are going to get squeezed. Basically, they're going to get forced to sell. People are going to be gobbling up at a discount, and then you're going to see mass supply hit the market. We see a crash. I don't think that's going to happen, actually, because take office out of it, but whether it's industrial, hospitality is actually doing really well right now. If you're considering multifamily, even though it's residential, commercial residential, these are assets that have high demand and are good properties with equity in them. They're just not qualifying for the debt that they hope for. So I think you're actually going to see an opportunity where investors are going to come in and participate in either mezz debt or preferred equity. We don't have time to go into what those two categories are in the capital stack, but if you're interested and want to hear more about how a real estate project is put together, we'll do a video on that. Basically what it means in very layman's terms, the lower you are on the capital stack, the safer position it is and the lower return. So if you're first position, which is typically your long-term debt, you're the first one to get paid. So return is going to be smaller. And then as the stack goes, up to where you're an investor, an equity investor, you're the last to get paid. And so you get the highest return. What I mean by preferred or mezz debt or preferred equity being the opportunity, I think you're going to be able to sit in a safer position in the capital stack and actually see a higher return than if you were in the pref equity or in the common equity position. Hopefully that wasn't too much of the weeds and it helped. Now we'll cover one more thing in real estate before we go over to the credit card issue. Today, NAR's membership is now shrinking for the first time in years. This is the National Association for Realtors. The organization's membership was down 0.66% in April compared to a year earlier. NAR thinks that the numbers are going to fall even further, which I expect so as well. Now, this is a typical cycle that you see in real estate. Basically, what it means is real estate agents or people who sell real estate are quitting their job. They no longer want to be real estate agents, and they're looking for other ways to make money. The reason why I say this isn't new is you typically see this trend in real estate that when things are good and homes are selling well, you see an influx of people that come in. And then when times get hard, you see people kind of leave. What I would say for anyone who is a real estate agent, and especially for the new ones coming in, I would not look at leaving. I think actually if you're leaving, you're missing out on one, a great opportunity, and two, a moment for you to really, really improve yourself and your skill. The reason why I say that is when times are good, you're not challenged. And there's nothing that really forces greatness out of you. You really improve when times get hard. This is when you're forced to really get out there and try things and, work through hearing no and being stressed out and having to build that resilience. That happens through a refining fire. I think for those that stick with it and learn how to do real estate when times are hard, then when times are good, people aren't going to be able to compete with you. This is where you go ahead leaps and bounds. The second part is if you're in this group that sticks with it, the relationships that you're going to build are going to last when the times get good. The reason why I say that is there are a lot of investors that can't wait for these moments. I'll use our company for the example. We are constantly looking for deals. We want deals to increase. And when there's uncertainty and things like this, when things like this happen, all of a sudden our deal flow goes through the roof. We're experiencing it right now. We have more deals than we can basically fund. We're having to turn projects down. That is great for us. So the relationships that we build in this moment where we're going after opportunity, once that relationship's built, we're going to work with these people as times get good. We're not just going to abandon them. So you could look at this as you building the foundation of what will be success or true success as things start picking up. So I would not recommend leaving. I'm a big believer in sticking with something when times are hard. Last one, this one is concerning. Credit card debt in the US hits all-time high of $930 billion. Okay, US credit card debt hit $930 billion with younger Americans having the highest delinquency rate. Okay, this is for the youth. Okay, we're gonna talk about credit cards. We're gonna talk about things that you can do to help and how to avoid this. Number one, I do believe it's important to have credit. I think as you're growing up, this is for the youth right now, you do want to build credit. And so, some things that you can do, you can ask if your parents will put you on as an authorized user on their account. That means as they spend, your credit gets built up. If you can't qualify for a credit card when you turn 18, get a secured credit card. Basically works very similar as a debit card. You have to put money in and spend on it. You get to a point where you will be able to open an unsecured line, open the unsecured line, and this will be your moment to build credit. The things that you need to be very careful of, and if you really think of this one thing, you will never have a problem. You should never pay interest on money borrowed from a credit card. You should pay this thing off every single month, no matter what. So if you can't afford it, do not buy it with a credit card. You follow that rule, you're going to do great. Now, what you're seeing here, I think, is twofold. One, we have inflation. We have something going on where it is much more expensive today than it was last year and the year before. And typically, for us as people, the last thing that we change is our lifestyle. The last thing we want to do is say no to something that we're used to doing. And what you end up seeing is people going into debt to be able to pay for lifestyle before they make the change. This is something that you see a lot with athletes. We get used to a certain lifestyle while we're making good money. Our careers end. We don't want to say no to the lifestyle. And this is why so many athletes go broke within those first 5 years into retirement from their pro career. We don't like changing lifestyle. What I would recommend, if you can't cover your expenses right now, you have two options. It's going to sound obvious. You either have to make more money or you have to cut back on expenses. Now, I think it's easier to go out and make more money, but cutting expenses is a very valuable thing to do as well as just painful. What you have to do if you're going to go through this, you have to separate your wants from your needs. The things that you're spending money on that you absolutely have to pay for or something really bad happens versus the things that we want to do. This is eating out. This is going on vacation. This is, instead of buying a plain white tee from Target, you're buying an on brand that, you're going to pay four times the amount. That difference from plain white tee to on brand, that would be a want. Cut back the wants as much as you can. Now, if you're in a scenario where everything you're spending your income on is needs and you're struggling to stay afloat, you have to either get a new job or create a side hustle or get a second. It's your only options. What we found, and I think this is important to mention, is if you pay yourself first, which means when every check comes in, you're going to take a certain percentage and automatically withdraw that to a savings account. And then that account, you're going to build out your emergency fund and then start investing once you have that emergency fund built out. By doing that, you're going to put a lot of pressure on yourself that you have to get a second job or else you're going to default on bills. And typically, we're not going to go through something like getting a second job unless we are at risk of defaulting. We typically won't do it just to save a little bit of money for our future. I think it's really valuable to do that though. On the credit card note, we've done videos going over FICO score and how you basically get to I think we did one on how to get to an 800 credit score. I'll include the link in case you want to go over that. But really, if all you focus on is pay that debt off every single month, and then I would say the second one is if you have $1,000 of credit available to you, only use about $200 to $300. You don't want to use your total limit. You want to keep it below 30%. That's actually a really valuable component as well. So I'll include that in there. I hope this is valuable. I hope this helps. What I would like to close on is there's a lot of uncertainty right now. There's a lot of fear. We see it. I have friends call me all the time asking what's going on. What I would hope to leave with everyone is in uncertainty, there's opportunity. So look for the opportunity. And also, these moments aren't new. 2007, 2008 was frightening. It was terrifying. It felt like America was never going to get back on track and it was going to be difficult forever. You get through these moments and then you get back to good times. This is very normal in the cycle of what we go through. And times like this will happen again. It will be in our future. Thank you guys. If you're not subscribed and you think this is valuable, please subscribe. Send this out to everybody. We appreciate you. We'll see you guys next week.